So good morning. I hope you all had a restful weekend and maybe productive weekend. One of the ideas in organizing the course this way was to put the fundamentals of the money view on Friday so that you have a chance to absorb them. Perhaps even if you didn't think about it directly, they enter into your sleep and you build knowledge. I was explaining to a student before class that one of the challenges of learning this way of thinking is that it has a whole big set of new concepts and it's not building so much on economics that you already know. As you may have seen, we haven't seen a utility function. We haven't seen a production function. We haven't seen a first order condition, setting equal to zero, maximization. All of these tools that we're used to. So we're in a different world entirely when we're talking about the money view. And so you can't expect it to come right away. It's more like learning a foreign language. You don't expect after 3 days of learning Chinese to be a fluent Mandarin speaker. You know, it takes a while. It takes a while. And you have to practice speaking it a little bit and maybe speak for a while with some native speakers in order to get very good at it. So this is partly what I'm trying to do, is to be an example of a native speaker of this new language that we're trying to learn here, which I call the money view. So Friday was about concepts, and you may remember at the end I was just foreshadowing what was going to happen after the weekend, that we were going to talk first of all about shadow banking and then about global money. So shadow banking is today and global money will be on Wednesday. And in some sense, shadow banking you can think of as extending the concepts of the money view to understanding the capital market. So long-term finance. Where does the money view intersect with modern finance and theory of asset pricing and so forth? And so that's what we're really going to do today. And the reason why that is important is because, well, two reasons. One, shadow banking is the form of modern banking that grew up with financial internationalization of finance and globalization. And I would say that it's the natural form of banking for that. I'll make this argument. And so we need to understand it. If we're going to have financial globalization, I think we're going to have shadow banking. So we better learn to understand it. But the second reason is because it was this kind of banking that collapsed, that caused the global financial crisis. So, and it was because we didn't understand it, okay, that we had this global financial crisis. So better understand it is the goal. I understand we're going to have this afternoon two presentations on shadow banking, one from the Bundesbank and one article that I wrote with some colleagues who are practitioners in this world. So this should be a introduction, getting ready for reading those articles. And I guess both of them you found rather challenging. Again, it's a new language, so you can't expect to understand it the first time through. Try again. Okay, so today I want to talk about the past, the present, and the future of shadow banking. When I say past, what I mean is to appreciate that some of the elements of this, it wasn't just created 20 years ago. You know, there are elements of it that have been of long standing, and that's helpful for us in order to get used to it and understand where it came from. It wasn't just some invention of a few ambitious people who knew modern finance in big investment banks in New York. You know, it has a longer origin than that. I want to begin by contrasting the world that Bagehot knew, Bagehot is Walter Bagehot from the 19th century England, wrote Lombard Street, you may know, the economics of London money markets. And he's talking about the world of that 19th century, and he's talking particularly about money markets. That's why I put that in red. There were capital markets, There were capital markets. There were bond markets of government bonds, so-called gilt securities, and there were other long-term bonds. But the connection between money markets and capital markets was not very direct. Okay, the money markets had their own logic, and basically, Bagehot is talking about only the money market side of it. London was the very center of the finance of world trade, okay, at that time. So when we talk about finance of world trade, we're talking about trade credit, we're talking about short-term bills, 3 months maximum, and bills that reference certain transactions, and in fact usually a certain collection of goods, so-called real bills. These are goods on the way towards sale, so that if you sell your goods to somebody and they might promise to pay you. They take the goods and they promise to pay you in 3 months. That's a bill. Okay, you can take that bill and discount it at a bank or endorse it and pass it off to somebody else. This is the world that Bagehot knew. It was the bills of exchange world, self-liquidating world, because these bills were supposed to be paid once the goods. Remember, the bills are issued when you buy goods, and then once the goods are sold, you get cash and you use the cash to pay back the bill. So they're meant to be self-liquidating in that way. They're financing goods on their way to sale, and when the sale happens, the bill gets paid off. That's the world that Bagehot is talking about, and that's a world mainly of funding liquidity, not of market liquidity. And so he focuses in that book, Lombard Street, on that problem. And I emphasize that because this concept of lender of last resort, the role of the central bank in backstopping a system like that, came from Lombard Street. If you haven't read Lombard Street, this would be a good thing to do. It's actually beautiful English. He was a great stylist in the English language, but it's also good economics, and it's talking about where the lender of, it's an argument that every time there's a financial crisis, the central bank steps up as the lender of last resort. They may claim they're not doing that. They may promise they'll never do it again, but actually they do it every time, and they will do it again. So why don't we make a principle of this? And that's the Bagehot principle. In a crisis, lend freely at a high interest rate against securities that would be good in normal times. When he's talking about securities, he's talking about these 3-month bills. Okay. That's how you can stop a crisis. I want to emphasize this last bullet point here, that when Bagehot was talking about lender of last resort, as opposed to modern economists, often they don't read Bagehot, and so they imagine what Bagehot said, instead of going to see what he said. But if you look and see what Bagehot said, he was emphasizing supporting money markets, the market for bills, making sure that these bills were liquid and would pass between. He was not particularly interested in lending to institutions, to particular broker-dealers, to particular people who were engaged in the bill trade. He was interested in supporting the market in general. That's the first thing. And the second thing, he wanted the central bank to operate as a discount operation. In other words, taking this bill as collateral for loans, not as just a direct lender to institutions, unsecured accommodations, those were called. The central bank did sometimes lend to individual institutions and sometimes lent without security, but it was embarrassed about that and it didn't really like to do that. The focus of the energy here is on supporting markets and with discount lending. You'll see why I'm emphasizing that. It's very often the case today, particularly I guess in the United States, that there's imagined a theory of lender of last resort, which is about lending unsecured to banks, too big to fail or something. And they're not putting up any collateral or anything. You're trying to keep this bank from failing. Bagehot was not interested in keeping banks from failing. He was interested in keeping markets from failing. And so this is, I think, a very important lesson for us, but he was only talking about money markets, because he's talking about a simpler world than the world we're living in. Across the ocean, or not at the same time, a little bit later, just at the beginning of this century, the world that Moulton knew. Harold Moulton was an American economist, and he wrote a series of papers in the Journal of Political Economy in which he was pointing out that the kind of banking that we know from Bagehot and from other European authors, money market banking, that model, and the theory that's built up around that model doesn't really work for the United States. Okay? The United States is an emerging market country, an agricultural country. It's a country where there's not so much trade finance and much more long-term finance. Mortgages on farms, railroad bonds, well, those are two long-term assets. And so having a banking system that's organized around short-term self-liquidating credit, this isn't the banking system that we have in the United States. And so we consequently are going to have a different kind of issue for backstopping this system. At the time he was writing, there was just a new central bank. The Fed was just creating, but there was no experience with this. Central banks had these illiquid farm mortgages and railroad bonds. There was no central bank. There was a lot of seasonality because the US was an agricultural country. So every fall when you need to move the crops, there's big expansion of credit and then contraction of credit. And every now and then one of those big expansions and contractions would lead to a financial crisis. And so I mentioned this in an earlier lecture, and there's no central bank, and so these financial crises typically sucked gold from London, and it became a global financial crisis. And so we eventually fixed that. But the way the US banking, this is important for understanding shadow banking, the way the US banking system worked even before a central bank, okay, was that they developed lots of mechanisms for using these bank assets, railroad bonds, farm mortgages, using them as collateral for borrowing from other banks. There were primitive repurchase agreements, where you would sell this bond, this railroad bond, to a big bank in New York, money center bank, okay, for 3 months, promising to buy it back, okay, when the 3 months are over. And there were long lists of bond ratings. This is where the bond rating institutions came from. They were to make it possible for you to sell this bond without there being a market for this bond, but using it really as collateral for this overnight borrowing and lending. So repo markets that we think of as some exotic new invention are not exotic and new, they're old, okay? And it's a natural bank invention. It was invented it was probably invented before that, but it was certainly widely used, a kind of repo transaction in the United States as a substitute for central banking. You couldn't discount these things at the central bank because there was no central bank. But in a sense, you could discount them with a New York private bank, with JP Morgan, by using them as collateral for borrowing. In a world like that, the key thing when you're running into a problem with crises is market liquidity, is making sure that these bonds are shiftable, that if whoever accepted them as collateral, if in fact they're not repaid, that they can sell these bonds to somebody else. Okay, but there's no central bank supporting that. And so that's why we had financial crises every now and then. And so when we got the central bank, Moulton is arguing, you've got to worry about market liquidity. You've got to worry about a list of collateral that you will accept at the central bank. Dealer of last resort, he didn't use that word, but he realized that that's how the U.S. system that's what the U.S. system was going to require. Whereas under Bagehot, the issue was a promise to pay, okay, funding liquidity. Under Moulton in the U.S., the issue was a promise to buy in order to support the value of collateral. So this primitive system that Moulton is talking about has become the global system, okay, 100 years later. And we've learned by experience what it requires as a backstop. But it took a while to learn that, and in fact, I mentioned this in the lecture on the history of money and banking. The first global financial crisis was the 1929 or 1931, depending on when you want to date it from, the crisis that inaugurated the worldwide Great Depression, where the Fed did not serve as the dealer of last resort. It said, oh no, what we know from European banking is that we need to be very careful and make sure that the banks have the wrong kinds of assets. They really shouldn't have mortgages. They shouldn't have railroad bonds. They should have short-term trade credits. And so this is our opportunity to really teach them a lesson. and as a consequence, they basically caused the banking system to collapse. They did not support the banks they actually had. They supported the banks they kind of wanted, okay? And there were no such banks. So the banking system collapsed, and when the US banking system collapsed, that reverberated around the world, and we had an international Great Depression. So we learned a lesson from that. And we learned a lesson in the United States. This is the Banking Act of 35, the Banking Act of 37 I mentioned before, and we learned a lesson about management in normal times, or we started to learn it. And I mentioned again in the lecture last Thursday about the moving toward thinking about dealer markets and how they work. That Keynes in the treatise was talking about commodity markets and normal backwardation. Then he developed this liquidity preference theory of the interest rate and the general theory. Hicks elaborated on, moved the theory of normal backwardation into a theory of the term structure. All of this was beginning, you know, we were developing ideas, but then there was another war and all that intellectual development was put on hold. And the story I told last Thursday was that the conversation in academia got dislocated from the conversation inside Central Bank of the United States. And they sort of moved on parallel tracks, actually not parallel, diverging tracks. Okay, so that in the last financial crisis, the central bank did the right thing. They acted as a dealer of last resort, but they didn't do it because the professors told them to. Okay, the professors did not have a theory to explain why you ran into this problem and what you should do, okay? Practical bankers, kind of in their feeling, you know, they figured it out, and they more or less did the right thing in order to prevent this crisis. They did what Moulton would have suggested, what a history of banking would have suggested, and now academia is catching up. That's what I'm trying to do, is to say, you know, the money view is really the right kind of approach for the existing monetary system that we have, and academia needs to catch up with the real world. Okay, so the part of the real world that we have to catch up with right now, okay, is shadow banking. So that's what I'm going to talk about. Okay, so that's connecting some dots from the past, and now I'm going to talk about the present. I should say that most of you are from Poland, okay? And I have learned in talking to bankers here in my days here that there's not a whole lot of shadow banking here in Poland. It's sort of ordinary banking, or the kind of banking deposits that are funding loans and so forth. That's all fine. Okay, and I think as Poland develops, there will be connections with the global system, and you'll start to engage with this much more deliberately. So it's not a waste of time to learn about this. That's the first thing. And the second thing is you need to understand that the prices, okay, the price of risk and the price of funding are determined in these markets I'm going to talk about here, not in Poland. Not in Poland. Poland is farther down the hierarchy, and it is a price taker in all of these markets. So understanding the global system that you're trying to connect to will be useful to you, even if this is not how Polish banking works. Got it? So I'm trying to give you a reason to learn something about something that is not right outside your window here in Poland. Okay, but is farther outside. At the center of the system in New York and London. So here, I'm getting a little warm. Let me take this jacket off, and that means I need to take this. Well, maybe I won't, because then I have to move the microphone. That would be too difficult. All right, I'll just wipe my brow. So here's my picture that I showed you, I think, at the end last time about shadow banking. What is shadow banking? Shadow banking is money market funding of capital market lending. And do I have a little laser pointer here? I don't see it. So I will use my finger to point. You can see up there in the upper left-hand corner here, I call it here a capital funding bank rather than a shadow bank. That's more just semantics to make it sound less shadowy and dangerous and dark, okay, something like that. But if you look at the structure of that balance sheet, you can see there's money market funding on the liability side and residential mortgage-backed securities, that's RMBS, so that's capital market lending on the asset side. So that's what I mean by shadow banking, money market funding of capital market lending. And I'm showing there that this residential mortgage-backed security is a collection of various risks, and that the shadow bank is hedging out some of those risks. Credit default swap would be a way to hedge out default risk. Okay? An interest rate swap is a way to hedge out duration risk, because these are 30-year mortgages, and so turn that collection into more of a short-term interest rate that you can fund in the money markets. In practice, in shadow banking, the shadow banking that broke in the global financial crisis, conceptually they were hedging these things out, but they didn't use CDS necessarily, they didn't use interest rate swaps necessarily, they were tranching, they were doing all kinds of complicated things. But if you look at it and you think, what are these things supposed to do, you can see, yeah, they were just trying to hedge out some risks in some way, or carve the risk off and sell it separately. So this is more of a conceptual framework for thinking about it than it is an actual map of reality, as it was before the crisis. And I think because of that, it will also be useful going forward. There's a very famous paper that Zoltan Pozsar wrote right after the crisis called Shadow Banking for the New York Fed that was an attempt to map exactly how the system worked. And it's a huge map with 50 different things. It's a beautiful thing. I have it framed in my office. But half of those things don't exist anymore. Okay. However, this does exist. Conceptually, shadow banking still exists. The way we do shadow banking is changing. Okay. The fact that we do shadow banking is not changing. Okay. This is the reality. So that's just as an aside. So that's the shadow bank there. The important thing to emphasize here, and this is where we connect up now to the money view, is that both the funding and the lending in this picture are, the price of those things is determined in dealer markets. So that money market funding is coming from a global money dealer, okay, who's making markets in funding, collecting deposits at one rate, lending them in wholesale money markets to the global shadow banking system at another rate. That's where the price of funding comes from, is in global money dealer markets. Okay? And where does the price of risk come from? In global risk markets. And I'm showing this as a dealer, as a derivative dealer that's making markets in credit default swaps and interest rate swaps. What I mean by making markets, just to remind you from Friday, okay, is a dealer that is quoting a two-way spread, a bid-ask. You know, you want to borrow money from me, here's the rate. You want to lend money to me, here's the rate. And there's a spread, and that's one of the sources of my profit. I also move that thing up or down depending on my balance sheet and my inventory position. If I'm getting net long, if I'm getting net short, you may remember the trainer model that we're talking about last time, which is, as far as I know, the simplest model you can imagine to start to conceptualize the nature of the dealer's problem. There's a version of the trainer model for money markets. There's a version of the trainer model for derivative dealers as well. That's where the prices come from. And I'm just showing the asset manager there as the counterparty going through the dealers, but at the other end, having a capital position, holding deposits as collateral for their derivative positions. They're exposing themselves to risk for investment purposes in the derivatives market. Again, this is a conceptualization. There are many other things in the world, okay, that might be on the balance sheet of these banks. There could be, I'm not saying that pension funds don't hold outright positions in residential mortgage-backed securities, or that there are no government securities. You see there's no government securities in this picture. Of course, there's lots of government securities, okay? We're used to this in economics. I'm focusing on the marginal source of credit, okay? And that's where the prices come from, not the inframarginal, okay? All this other stuff, cash positions and so forth, we can abstract from in order to, in this understanding of the world. What I want to emphasize, last two bullet points here, putting emphasis here on the markets where the price of money and the price of risk get determined, not particularly on the institutions. So when I say dealer here, okay, I want you not specifically to have in mind somebody who works in one of those tall buildings downtown, you know, the Goldman Sachs building, or I don't know if you have a Credit Suisse building or one of those buildings. They have dealer operations, they do, okay? But let's be more general than that. What I mean by dealer is anyone who is, as a matter of their speculative strategy, is making markets, okay, by offering to buy, offering options to trade, And that could be day traders. It could be even people who aren't aware that they're being dealers. Okay, so they don't have to call themselves dealers. They don't have to be regulated as dealers. What's important for us is conceptually to understand that that's where prices are coming from. Anyone who's behaving in this way, we want to understand their behavior. And our model, the trainer model, is perfectly general. Right? It can be, anyone can set up business and try to trade like that. You don't have to declare yourself. You know, the title of my business is I'm a broker-dealer. Individuals can do that. So making markets, money, and risk, I went through this a little slowly so that we can conceptually understand what we mean by shadow banking. Shadow banking is kind of like ordinary banking. What is ordinary banking? It's an institution that takes in deposits and makes loans. Shadow banking is like the wholesale version of that. They're not funding themselves with deposits. I'm showing that the global money dealer is funding itself with deposits. The shadow bank is funding itself with wholesale money borrowing. Okay, so it's borrowing in the 3-month money markets globally. And what does a normal bank do? They make loans. Here I'm showing that these loans are being securitized and turned into bonds, basically, and that's what a residential mortgage security is. So it's not the same process that we're familiar with in a bank. Deposits are funding mortgage loans, okay, is actually happening here, okay? But the important economics is in the wholesale markets where prices are being determined by profit-seeking dealers. So far, so good? Okay. How does this system respond to stress? What are the backstops if things go wrong? Well, there's two kinds of things that might go wrong. One is that you might have a solvency problem, that some of these assets go bad or counterparties don't pay you or something like that. And the other could be a liquidity problem where you're hitting the survival constraint that I mentioned in terms of payments. To backstop those two conceivable issues, like solvency issues and liquidity issues, you need capital for the first one, solvency, and I'm showing that as a liability of the dealers. And to backstop a liquidity problem, you need reserves, which I'm showing as an asset of the dealer. I'm emphasizing, note, the robustness of the dealers, not of the shadow banks themselves, okay? Because this is what we're concerned about in backstopping is, are these markets going to continue working, okay? Any given shadow bank may collapse or not, okay? But as long as the markets keep operating, there's not going to be a systemic effect on the economy as a whole. So, but if the dealers collapse, there will be, okay? Because the markets will freeze up and everyone will, this is the core of the system. Everyone will start to be in problems, even shadow banks that seem to be fine, you know, were running good businesses. If you can't roll your funding, you're dead. And if you can't, and why couldn't you roll your funding if the money market dealer stops doing business? That's the end of the story. There's not liquid markets for you to fund your ongoing shadow banking business. So that's why we're focusing on the dealers here. Typically, you know, these are highly leveraged business, and so there's not going to be very much capital, and there's not going to be very much reserves. So the actual source of liquidity, and from now on I'm going to focus on liquidity, not so much on solvency, just because this is a money view kind of class here. Not that there aren't solvency problems, but the liquidity part, I think, is what caused the global financial crisis, and certainly the part that we need to understand from a money and banking perspective. So what was important, and what is important today, is the ability of these dealers to if they don't have monetary liquidity, i.e. some sort of inventory of cash or deposit accounts, if they run out of that, which they're going to run out very fast, okay, even with substantial reserves, this is always the case. So they need to be able to access other liquidity, and so that's why I'm putting here as an asset, a liquidity put, I'm calling it. So it's sort of an option to borrow, and I'm treating it as an asset. It's like a credit line. It's an option to borrow, so that if you need to acquire liquidity, you can. And who is the other side of that? I'm showing the way the system existed before the crisis, which I think people didn't necessarily even understand that it was organized this way. We learned this in the crisis, that the way it was organized, so now I'm just showing the balance sheet of the global money dealer and the derivative dealer with the liquidity put sitting there, okay, in red, okay, as an asset. And that's their asset, and whose liability is it? I'm saying it's the liability of the traditional banking system, these two here. The liquidity put of the global money dealer, the liquidity put of the derivative dealer. Okay? One person's asset is another person's liability. So that when the shadow banking system came under stress in the global financial crisis, what happened was that the shadow banking part went to their backstop in the traditional banking system, in particular Citibank, okay? Or other divisions of the banks that they were in. In Europe, often the shadow bank and the traditional bank were in the same organization. So that the division that was doing shadow banking went to the rest of the bank and said, okay, you got to help us out here for a while. We have to roll our funding. Can you help us out here? So that it might not even have been an explicit contract. It was just a sort of, we'll help you if you need, we're in the same organization, so we'll help you if you need it. And that's how the problems in the shadow banking system became problems for the traditional banking system, for Citibank, for Deutsche Bank, for Union Bank of Switzerland, okay, and so forth. And of course, who backstops the traditional banking system? The central banks. So that's how the shadow banking problems became a problem for the central bank. Because once they were a problem for the traditional banking system, they were a problem for the central bank. So that's why I'm showing that there's a liquidity put from the traditional bank to the central bank. And I'm putting here on this balance sheet that it's a connection between the traditional banking system and the C6, okay, the collection of central banks globally. So it wasn't just your domestic central bank here in Europe, Union Bank of Switzerland or Deutsche Bank, as I say. What they needed to do was to roll their dollar funding, which meant that they really needed access to the Fed, but they have no legal access to the Fed, so they did it indirectly through the ECB. They borrowed dollars from the ECB, and the ECB borrowed dollars from the Fed. So it's the C6 that proved to be the liquidity backstop of all this stuff up here, and it was layered like that. Just as a little aside, one of the things that's happened after the crisis is that the financial regulators have realized, like, why did we insist that it go through these layers? That first of all, the shadow banking system has to collapse, and then it has to bring the traditional banking system almost to collapse, and then we'll do something. Okay, so central banks now have developed various mechanisms to backstop the shadow banking system directly. Okay, so that these liquidity puts are puts to the central bank balance sheet, not to the banking system, and so that you can help the shadow banking system without requiring first that it imperil the traditional banking system. So in the next crisis, as it comes, we will see if these mechanisms work. Okay, you may have seen some of these headlines a couple of years ago. The Bank of England said, we're open for business. They are providing liquidity backstops for the non-bank sector. And other central banks are doing some versions of this. I think probably the Bank of England is the leader in this. But they're realizing that this kind of indirect thing led to inefficiency and too little too late. And so it's better to be more direct. But conceptually, you can see it was always the case that the liquidity backstop of the shadow banking system was the central bank anyway. Okay, so if you skip a step, you're not actually changing the reality, you're just making it more efficient. The next couple slides, I'm telling a story about the financial crisis, the global financial crisis 10 years ago, where it came from, why it took the form it did. This story is exactly the story that I tell in that paper that I wrote with James Sweeney and Zoltan Pozar and my former student Daniel Nielsen. In the paper you're reading for today, Badgett was a shadow banker, and we're going to hear about that paper this afternoon, student presentation. Our goal in that paper, at the time we wrote that, everyone was treating the financial crisis as a problem of solvency. That the problem was that a lot of bad loans had been made, subprime loans, okay? And we needed to wipe those loans out and wipe out the people who made those loans and recapitalize the banks. Solvency problem. Okay. And so we thought that was ignoring very serious and important liquidity issues here. And so we decided to write a paper in which we would ignore all the solvency problems, okay, and focus only on liquidity problems. That's not to say that there were no solvency problems, but this is the way we do things in economics, right? You abstract from something. So my little model, this is where this model of shadow banking came from this paper. And it's set up so specifically so that there's no conceivable problems of solvency, only problems of liquidity. And we told a story about the boom and the bust of the shadow banking system. And so if you want the details of this, go to that paper. I'm just meaning here to kind of try to inspire you to go to the paper and study it. The basic story is about the expansion of mortgage lending, which we talked about in lecture 1, you know, the way that banks make mortgages by expanding their balance sheets on both sides. Okay. That's one thing that's going on. And the other thing that's going on is the expansion of the shadow banking system to absorb some of those mortgages. Okay. So these things don't necessarily operate at exactly the same time. And the story I'm telling is that the expansion of new mortgages got ahead of shadow banking. And so as more mortgages are expanding, that creates incentive for creating more shadow banks to take that stuff off the balance sheet of banks. And then they go back and they create some more mortgages, and then they move it onto the shadow banking system. And then they create some more mortgages, and they move it onto the shadow banking system. Okay. That's the boom. And then when that whole thing stops, and there becomes problems, and remember the shadow banking system operates with short-term funding, and there's some anxiety, well, maybe we overdid it. You know, we created too many shadow banks. Well, let's collapse some of these shadow banks and go backwards. Going backwards is a very different story, okay? And that's what caused the crisis. So that's in words what I'm going to now show you in balance sheets and in the trainer diagram. So I'm showing here the movement of when there's increasing numbers of mortgages being made and securitized, and how that shows up in the pressure on asset prices and money market funding prices coming from the asset managers, that pushes the inventories of global money dealers around, it pushes the inventories of derivative dealers around, and it pushes prices around. That's what I'm showing here. That they're developing short positions. These are not prices, these are yields. These are rates of interest, but they're just inverses. That's why the lines are sloping upward instead of downward, as when I was showing you. So the prices, so that creates an incentive for creating a shadow bank, because it's very cheap to create one, okay, and the cost of risk is very low, which means the price of these assets is very high. So there's a booming time. There's a boom time. So the story about it's a kind of disequilibrium story about a boom, where the prices are moved around in order to create incentives to create shadow banks, and so they're creating shadow banks. Then, when the tide turns, the pressure on the system is coming from the other side, not from the asset dealer, okay, but from the shadow banks themselves, saying, look, we're having problem rolling our funding. Please help us with that. And the dealer is quoting a spread. So that's their job, is to do that. Or if you're trying to collapse the shadow banking, break it into pieces, that pressure can also show up in the derivative market. And again, that's what derivative dealers do, is absorb imbalances in the supply and demand of risk for a price. Now the pressure is coming from the opposite side, and so the effect on price is the opposite also. And that's what I'm showing here, that all of these risk premia and funding yields, okay, are now pushing the dealer's balance sheet around, and so they're moving the prices they quote around. So maybe you remember before it was over here, now it's shifting over here. And the dealers can absorb some of this, okay, but if it gets too bad, they start realizing losses, and when they realize losses, their ability to support their balance sheet shrinks. And that's what I'm showing with this shift to the left in their maximum exposure here. Shift to the left. See, this contraction of position limits, that the dealers say, you know, I'm discovering that I thought I was absorbing this temporary imbalance on my balance sheet, and that there would soon be someone to come and demand it and take it off my balance sheet. So I was willing to expand my balance sheet for expected profit. Now I'm seeing, I don't see expected profit. I see expected losses, okay? I don't want to expand my balance sheet anymore. Not only do I not want to, my bankers who are lending me money for all of this are saying, we're a little worried about you. You know, maybe you need to pull in your horns a little bit and be a little more careful. So that's what this is, pulling in your horns a little bit, being a little more careful. And then you find out you have all this excess exposure. All of the dealers have the same position because this is a macroeconomic thing. Who are you going to sell this to? You have an excess exposure. There's no one to sell it to, okay, except the central bank. And that's what happened. And that's what happened. I'm showing here in this balance sheet, we saw a little bit of this in the student presentation in the very first day, this balance sheet on the right. Let me just go through a little bit how that balance sheet was constructed. This is the balance sheet of the Fed as of December 15th, 2011. So it's the end of the crisis and the beginning of this whole adventure with quantitative easing and everything. But it's the end of the budget part, you know, the supporting the collapsing system. And there had been a tripling of the size of the balance sheet of the Fed. It had been about a little bit less than $1 trillion, and there was a big change in the composition of that balance sheet too. So it had about 1.7 trillion of treasuries by the end, about 0.9 trillion of mortgage-backed securities, and so forth. 0.3 of various other little things. It had issued a little bit more currency, so it had $1 trillion, but mostly it had an incredible amount of excess reserves, 1.6 trillion. That's what the balance sheet looked like. You can go back in history, you can go back on the Fed's balance sheet and you'll see. I've consolidated some categories so that conceptually we can understand this. Now I want to link this up to our little model of shadow banking. Okay. Remember our little model of shadow banking that I just showed you? Okay. Where I was showing you that we're expecting that the central bank is providing some kind of liquidity put for the derivative dealers and for the global money dealers, maybe indirectly through the banking system. So now I'm going to show you that that's exactly what they did. You can't see it in this balance sheet, right? It looks like they bought treasuries and they issued reserves, okay? So let's just manipulate those numbers a little bit in order to show the risk exposures, not the assets you're holding, but the risk exposures. So to move from the left to the right, what I've done here is to add treasury bills on both sides, 2.6 trillion and 2.6 trillion of treasury bills on both sides. So that's just expanding the balance sheet on both sides. It's not changing the net exposure at all. That's why I put these in brackets, because these are kind of notional exposures. And I'm adding in some treasury bonds too on both sides, and then 0.9 treasury bonds on both sides, and then adding it up to the treasuries. That's how you get 2.6. So that blows up the balance sheet to 6.4 trillion notional, okay, not actual. You know, this is the actual balance sheet, 2.9 trillion. I'm just saying, if we were thinking, if the Fed had been operating in derivatives markets, okay, and what would its position have looked like? The top line there, what is that position? That's a short position in cash, currency and reserves, and a long position in treasury bill. That's like an overnight index swap. Conceptually, the economic exposure, the risk exposure, it's like an overnight index swap, a money market instrument, okay? The second line, long position in treasury bonds, a short position in treasury bills, this is like an interest rate swap, okay? So it's a risk position in duration. The Fed is not allowed to hold interest rate swaps. Many central banks are. The Fed is not, but it can create the same risk exposure through this kind of thing. And the second one is basically like a credit default swap. You're holding risky securities, long-term risky securities, long position, and a short position in long-term risk-free securities. So you have this default risk that you're exposed to. That's like a credit default swap. So the Fed has these synthetic swap positions implicitly on its balance sheet. Let's just now call them what they are conceptually, okay? And you see that there's 2.6 trillion backstop of the money market dealers, overnight index swap. There's 2.6 trillion of the derivative dealers in interest rate swaps. There's 0.9 trillion of the derivative dealers in credit default swaps, okay? The Fed has backstopped the dealer system by becoming a dealer. It's backstopped the shadow banking system. That's how we managed to end the crisis, by the Fed doing this. Did they realize they were doing this? I'm not sure. They certainly did not have this sort of clean theory of how the shadow banking system worked and therefore what kind of last resort support it needed. They were responding to the pressures in front of them. They were inventing all, you're too young to remember this, but every week there'd be a new little facility that was created. It looked chaotic, okay? This is me after the fact saying, well, what was the logic of all of that? Why did it work? What was it actually doing? What it was doing was backstopping the dealers who made markets for the price of funding and the price of risk in the shadow banking system. And it worked. And it will work again, hopefully. Now that we understand it, we can do it sooner, before it threatens another Great Depression. We can do it in a more targeted way without making it threaten the whole banking system first. So that's the whole idea. Let's learn the lessons from this crisis, the future. Okay, doing well here on the time. So that's present. I suppose that's not actually present, that's 10 years ago. But as a historian, that's present, really. So there have been some institutional changes that have been put in place after the crisis. Changes in regulation. All of these institutional changes come from various implicit theories of what's wrong, but also pressure from industry groups and pressure from government groups. And so again, just like after the crisis, I had to say, well, there's like all of these big, long alphabet city list of facilities that the Fed created. What's the logic of that? Okay. Now I'm trying to say there's all this, Dodd-Frank is like all these hundreds of pages. What is the implicit logic of this? For a while, at the time, I couldn't see any. It seemed like a mess. But that was the way it was in the crisis too. Now, with a little bit of distance, it seems to me that the outlines of an emerging new system we can sort of see. And these are just a few of the things that are happening. We can talk about other things as well. Tomorrow at the central bank, I'm going to talk more specifically about monetary policy and so forth. But one of the big things that's happening, which I'm emphasizing here, changes in the dealer system, right? Because remember, the way this theory works, it says the dealer system is what you want to focus your mind on, okay? Because that's where prices are coming from. And by the dealer system, we mean the money market dealers and we mean the risk dealers. So we want to be focusing our attention on those. And when we think about reform, what are they doing to those dealers? What's happening to that? The biggest thing that happened is there was some theory somewhere, political economic theory, that the way to protect the taxpayer from bailouts, okay, was to distinguish between two different kinds of dealers. Okay. One is a matched book dealer, okay, that has equal and opposite positions on both sides of its balance sheet. So it's not actually taking any positional risk. It's not betting on the direction. It's just buying low and selling high and holding both of those positions on its balance sheet so that they go up on both sides or go down on both sides, and it's not going to have any change in its net asset position. Okay? A clearinghouse is, by construction, a matched book dealer. It's just like this, that it has equal and opposite positions on both sides. So they took the matched book part of the dealer system and moved it into a new kind of institution that they called central clearing counterparties. Okay? They created clearinghouses for money markets and for risk dealers. And these things are operating now. So they split the dealer function into two pieces. One was the matched book piece, and one is the proprietary trading piece, okay, which is where you are taking positional bets, where you have imbalanced inventory. That's what the second bullet point is there too. People who have banking licenses, not people, institutions that have banking licenses are not allowed to do mismatched book dealing. That's what Dodd-Frank does. But hedge funds can, and lots of other people can. So that's why I emphasize the dealer function is what's important, okay? Not what the name is on your firm, okay? You can do this sort of thing if you're a speculative dealer and make money by anticipating expected profit, just as these things used to be all on the balance sheet of the big investment banks. And they were commingled. The investment banks did not make any distinction between the matched book part of their operation and the net exposure of their operation. Now they do. The matched book part, they package together and push it off their balance sheet. So if you look at the data on the big investment banks, you see that their balance sheets have shrunk a great deal. Some people think that that indicates that these banks are being whittled down to size. No, what's really happening is that you're taking equal and opposite asset and liability positions and just booking them in some other organization, these central counterparties. Other things are happening too, but that's one piece of it. So I'm saying we created these central clearing counterparties, matched book dealers, in money markets and in risk markets, and then and shifted around who's able to do this mismatched book dealing. It took a little while, because what we did was to say, you, group of institutions who are doing this, who used to be doing it, you can't do it anymore. You can't do it anymore. So that led to some problems for a while until new institutional arrangements grew up and started to do this instead. And why was that a problem? Okay. Many people would say, oh, that's great, we eliminated speculation. But if you take a money view, you realize these dealers, when they're making markets, they are stepping in when there's a mismatch between supply and demand. If there was no mismatch between supply and demand, a matched book dealer would be fine, because you're just matching, you're more like a broker, you're just matching two sides, okay? But if there's a mismatch, okay, then you have to use your own balance sheet. You have to step up and buy things that nobody wants or sell things that everybody wants, you know, so that you're making up in quantity on your own balance sheet for what would otherwise have to be made up in price. Much wider fluctuations in price. So that's why over the last 10 years, every now and then, it feels like the prices just go crazy, okay, because there's no one stabilizing them. You know, there's no, we haven't built the institutional infrastructure to make that happen. And so when they go crazy, and there isn't this institutional infrastructure yet, the central banks come in and they act again as sort of dealer of last resort, stabilizing this. But that's not a solution. We need to be building this structure, and it is getting built, as far as I can see. So that's one, dealer differentiation, I call that. Differentiating between the matched book part of the dealer system and the speculative dealer part of the system. That's one thing that's happening. And from a dealer point of view, from a money view point of view, that's clearly an important thing, because we put our attention on the dealer system. So now, just to really nail that point, I want to just show you in balance sheets how a central clearing counterparty works. You know, I saw some people looking a little dazed. So let's go through this a little more slowly so that we can understand this. This is not rocket science. We can understand this. What I'm showing here is how a money market central clearing counterparty works. I'm showing a customer, one, okay, who has some bonds there, government bonds, maybe mortgage-backed securities, who knows, okay? And they wish to raise liquidity. They wish to raise funding, okay, using these bonds as collateral. So they offer these bonds in the repo market. So that's what a repo is. I'm selling these bonds temporarily to someone, and they're giving me cash. They're giving me a deposit account. So I'm showing that here as a repo, or I'm calling it a reverse here just so that you can see whose side, who is who there, as a liability. So I'm borrowing money using these bonds as collateral. That's why it's a liability. And the money I'm borrowing is that asset there, the deposit account. The dealer bank is on the opposite side of that transaction, okay? They're lending money, and they're lending money by just creating it out of thin air, the way banks do. They're expanding their own balance sheet. That's not new. We've done that before in this class. What's new is that we're booking that transaction, the repo part of it, on the balance sheet of a central clearing counterparty. So you can see there that the deposit account part is an asset of the customer and a liability of the dealer bank, but the repo part is not. Okay? The repo part is a liability of the customer and an asset of the CCP. Okay? It's a liability of the CCP and an asset of the dealer. And if you look at the balance sheet of the CCP, you see they're a matched book dealer. They have equal and opposite position in repo on both sides. The contract is the same on both sides. So fluctuations in interest rates, fluctuations in the value of the collateral, they affect both sides of the balance sheet at the same time. This is a matched book dealer. That's showing customer one. Then I'm showing in the second line, customer two, I call them, who's doing the opposite. They have cash that they wish to invest for a short period of time in the repo market. So they draw down their deposit account and they buy a repo as an asset from a dealer bank, and the effect of that is to net out these deposits, so the balance sheet of the bank shrinks back down again. It also, and that new repo is also booked at the CCP here. That repo of the customer asset is a liability of the CCP here. That liability of the dealer bank is an asset of the CCP here. So that new transaction is also a matched book transaction. So by construction, the CCP is always matched book. But look what's happened. I said how the deposit accounts cancel on the balance sheet of the dealer bank, right? The deposit accounts cancel. But so does the dealer's exposure to the CCP, right? The dealer had a liability repo and an asset. Say the CCP deals with this dealer on a net basis. So the dealer now is flat. The dealer has no exposure to the CCP. The CCP is basically, on one side, it has a liability to customer two, and on the other side, it has liability to customer one. The dealer system is out of the picture, or rather the bank is out of the picture. This is the way that works for money. The construction of a matched book through the flow of repo, initially mismatched flow, right? They don't line up. The customer one and customer two don't come at the same time. But nonetheless, the CCP can be matched book because for a while, its counterparty is the dealer, okay? And then the dealer nets out when the next line comes. Here, I'm just showing the same thing for swap markets, risk markets, so interest rate swaps or credit default swaps. And again, the point is that at the end of the day, so one customer wants a swap in one direction, one wants a swap in the other direction, and they wind up on the balance sheet of the CCP here, and the dealer's positions net out and wipe out so that there's no net position there. So that's the same thing for risk. I went through a little more slowly with the money part and showing both sides of the transaction. Here, I'm not showing the notionals, just the swap itself. This kind of thing is now everywhere at the center of the global system. And because it's everywhere, it's useful to try to think. In a matchbook world, where's the source of stress? How can we have liquidity problems in a matched book world? So this is from another paper I wrote a while ago, imagining a matched book world and thinking about that problem. Okay. So look at this set of balance sheets. This is the same set of balance sheets that we've seen that I saw at the beginning about shadow banking, the capital funding bank there, okay? Except now I'm putting numbers on them. There's $100 worth of residential mortgage-backed securities. I'm showing that at inception, the swap position has a value of 0. It's just which typically they are swap positions at inception, and so is the interest rate swap. And so there's 100 that is financed in the money market for 100, going through the global money dealer, and so forth. All the numbers add up, you can see, just like our conceptual framework. I told you back when we were starting that so this framework comes from that Badgett was a shadow banker paper. And I told you that one of the goals of that paper was to create a story of financial crisis that's entirely about liquidity and not at all about solvency. So I want to take a little moment here and show you how we did that, how that trick was done. In what sense is this abstracting from solvency? Okay. What you can see here is that all of the lending is completely secured. We're imagining that this residential mortgage-backed security here is being used as collateral for the money market funding, okay? And that collateral can pass through potentially and serve as collateral even for this deposit account here can pass through the dealer and serve there. Similarly, these credit default swaps, okay, that the asset manager is taking the risk on, okay, that asset manager has $100 worth of cash collateral that they can use to support their dealer positions, and that can pass through the derivative dealer to the capital funding bank. At the inception, there doesn't need to be very much collateral because these things are worth zero, okay? But as the prices change, there's going to be collateral movements, and that's what we want to look at. Here's the key. Remember last time I talked about the survival constraint, and we were thinking about payments there, right? We were thinking about I've bought more stuff than I have sold, and so I need somehow to make a payment here. Now we're not talking about stuff, okay? We're talking about financial value, and we're talking about not actually necessarily cash flow to make payments, but collateral flows. So this survival constraint idea also applies in the world of collateral flows, not in the modern world. This is something Copeland in 1952 never imagined, okay? But this is a very big deal. If you were paying attention 10 years ago, AIG collapsed. Why? Because of collateral flows. It was a margin call. It's a margin call from Goldman Sachs and Societe Generale. That's what it was. It was a survival constraint problem, but in the collateral market, the collateral on their derivative positions that they had written. So this is where the problems can arise, even in a matched book system, with no solvency problem. I've just shown you if these credit default swaps, you know, and interest rate swaps, suppose that these residential mortgage-backed securities just completely collapse. They all go to zero. Okay. That means that the credit default swaps and the interest rate swaps all come into the money, and they all move to 100. Okay, that's the nature. It's a risk that's hedged. It's insurance. That means that the asset manager now owes 100, but they have the capital for it and they have the liquidity for it. So the asset manager takes a solvency loss and takes a liquidity loss, no problem. Okay. I mean, it's a problem for their other liabilities, their pension liabilities, but there's no reason that they would go bankrupt. That's what I'm saying, that by construction, there's no solvency problem. You can have 100% collateral behind everything in this structure. So we've ruled out solvency, so what problems remain? Liquidity problems. I'm showing here a value fluctuation. Okay, so I'm imagining that the value of these mortgage-backed securities, market value, if you were going to sell them, the price of them, as it's quoted in the stock market, fluctuates. It's not 100 anymore, it's 90. Nothing necessarily has to change. You know, we have these balance sheets. I'm showing that the shadow bank, that just means that its hedge, its risk hedge is now in the money. The credit default swap is worth 10 if you set up the hedge right. And similarly for everywhere else, you know, in the derivative dealer, the credit default swap is a liability, but it's also an asset. It's a matched book here. Everything can conceivably work, okay? The problem is that now, if the residential mortgage-backed security is being used as collateral for the money market funding, there's going to be a collateral call. It's like, you've got collateral that's only worth 90 and you're borrowing 100 from me. So could you please put up some more collateral? Will the global money dealer allow you to put up the unrealized value of your credit default swap as collateral for your money market borrowing? You know, unlikely, okay? That means that there's a liquidity problem for the shadow bank. They need to acquire liquidity from somewhere. That's why I say lender of last resort. or dealer of last resort to support the markets in these things. So there can be liquidity problems because of the collateral flows that are implied by fluctuation. Similarly, if the credit default swap moves in the money, that means that the asset manager needs to give collateral to the derivative dealer, okay? Which it has plenty there. It's got those deposit accounts. It might conceivably give, but will the derivative dealer then be able to pass that collateral on to this to support that position, which will then get passed on to support the funding position? There's a lot of opportunity for slippage here, is the point. Okay, and anytime there's an opportunity for slippage, something can break. And if something can break, the whole thing can break. Okay, so this is just to try to show you at a sort of very simple, abstract level, the kind of liquidity problems that arise even if you've made everything as safe as possible from a solvency point of view. You've made everything, and that's where the regulation first started. They said, let's make everything as safe as possible from a solvency position. Let's increase the capital requirements. Let's do all this. Okay. And then many people had theories of money that led them to believe that that's all we need to do. That's why I wrote this paper 5 years ago saying, you'll find out that's not all you need to do. Once you've solved all those problems, then you're going to realize you still have these other problems, and they are liquidity problems. So this is showing the problems of just value fluctuation. That fluctuation may be just for a week and then it goes away, right? So you're talking about collateral flows that backstop these things, and then the collateral flows back again. So it might just be temporary, but it might also be permanent. And that requires cash flows now. That requires writing down assets, okay, and making payments. And so I'm now showing, tearing up those, taking those CDS positions back to zero by actually making a payment, okay, that there's $10 actually moving through here, and everything is contracting so that now instead of there being $100 worth of credit outstanding, there's $90 worth of credit outstanding. But that requires payments being made to cancel out existing debt. So I'm just distinguishing in these two balance sheets between collateral flows and the kind of survival constraint that comes from a margin call for collateral, and payment flows and the survival constraint that comes from those needs. They're both survival constraints, and in the modern shadow banking system, they're interrelated. Okay? One is sort of permanent. If the flow is permanent, then it's cash, okay? If it's just topping up your collateral for your ongoing swap position, the collateral goes in, the collateral comes back. That's what AIG thought they were doing when they first posted $80 billion worth of collateral to Goldman Sachs. They thought, we have all these AAA credit default swaps, okay? AAA. Nothing is going to happen to these assets. So yes, it's true that the collateral call is bad, $80 billion, that's a lot of money, but we're going to give it to them and then we're going to get it back. Okay, didn't happen, did it? Okay, give it to them and then the situation got worse and AIG went away and Goldman kept the money, okay, and turned it into cash. So that's, in my mind, as an example of the kind of thing that can go wrong, that was extremely surprising to everybody and led the government to have to come in and figure this thing out and sort this thing out. And remember, that was the same weekend. AIG failed, and then Lehman failed, and then it looked like the whole world was going to fail. So it was liquidity problems of this kind that were unanticipated by the people who built the system that threatened us. And so I say, let's learn our lesson about that, and let's put in some liquidity backstops to make sure that it doesn't happen again. All right. That's the example that I wanted to give for shadow banking. The last point I wanted to make about shadow banking is this. All the example I've been showing you there has been in one country, treating it as if it's all dollars. And it was all dollars, although it wasn't all in one country. The shadow banks were in Europe, as a matter of fact, and the backstops were in the United States, and it was in fact international. And the shadow banking, and so that's why there's no foreign exchange exposure in those diagrams that I was just showing you. In the real world, it's a larger system than that. Okay, it's a global system. It's also a system in which there are some of these capital market lending is in foreign exchange. and then it's being swapped into dollars, it's being funded in dollars. So there's a currency exposure here that also has to be hedged out in the foreign exchange swap market. So it's just another risk from a shadow banking point of view. You know, there's credit default swaps for default risk, there's interest rate swaps for interest rate risk, there's foreign exchange swaps for foreign exchange risk. You can just swap it out. This is another layer of it. But as a global system, the foreign exchange swaps are particularly important. And since the next lecture is going to be about global money, I thought I would use this last few minutes to segue from global banking, which is shadow banking, to global money. And I think I've shown you some of this before, reminding you, and some of this has also changed since the crisis. There was a reason that the crisis was global, and it was because the dollar money market is the global money market. So when you disrupt the dollar money market, you disrupt everything, everything. So we have made some changes in how that's organized. It is now at the top of the system. We appreciate that the dollar is the world reserve currency. And there are swap lines that separate, that connect the Fed to other major central banks. And then there are bilateral swap lines from those other major central banks to others farther down. Poland is farther down, swap line with the ECB, basically, and then ECB has swap line with the Fed. And there are regional arrangements for others and the IMF. So here, you've seen this picture before, just a conceptualization of the emerging international monetary system. That it's hierarchical. The very first lecture, I emphasized it's a hierarchical system, and that this is one of the conceptual difficulties we have because we so strongly believe, particularly here in Poland, like I'm a country just like you, and so we're equal, the Westphalian idea in terms of sovereignty. Well, maybe so, but your liabilities are not equal to liabilities of the U.S. government. And in the international monetary system, the dollar is the coin of the realm, and that's for reasons that we've talked about. This isn't about sort of oppression or and privilege necessarily. What I want to emphasize here at the end, just to get us ready for thinking about global money on Wednesday, is that we're going to be extending the money view intellectual framework, conceptual framework, to global money as well. Okay? That means thinking of each nation as a cash inflow, cash outflow entity. Okay? That means of thinking of the balance of payments. You are all studying balance of payments. Thinking of balance of payments as a settlement constraint. Okay, as a survival constraint even for the nation. How do you manage that? That nations as a whole are banking units, okay, in this way. And if you can try to hold monetary reserves, okay, as your first line of defense, but ultimately you're going to need to have a credit line of some kind. That's what a swap line is. And ultimately, in a global system like this, market liquidity becomes key. The asymmetry that I mentioned about the settlement constraint, right? That it's deficit agents that have to adjust, not surplus agents. That's true of countries too, okay? You're not off the hook just because you write your own laws, okay? You're a deficit agent, you need to settle in some coin that is acceptable to the creditor, or borrow in some coin that is acceptable to the creditor. It's a hierarchical system. The higher layers can offer delay of settlement to the lower layers for a price. That's what these swap lines are. They're higher layers, okay? And that's what the IMF is doing. That's what all these regional arrangements are. So we're going to be looking at the international monetary system as a payment system and integrating that in, and then understanding the shadow banking system as a global banking system, because we'll have the global money part in there as well. And not just as a payment system, but as a market-making system. So the key price in the international market, okay, is not par. When we're thinking about domestic money, we're thinking about par between shadow money and deposits. How is that maintained in a money market mutual fund or something like that? When we're talking about international, the price is the exchange rate. Okay, and we will have a theory. We'll talk about a theory of exchange rates that puts dealers at the center of attention. Foreign exchange dealers who are absorbing fluctuations in the demand and supply of the local currency relative to the global currency, just like our trainer model. Okay, that same model works for foreign exchange, as well as for money markets, as well as for risk markets. It's the same idea that there are profit-seeking dealers that are supplying liquidity in foreign exchange markets for a price, and that price is expected profit. The fact that foreign exchange markets are not just the price of one currency with another, but also involve states and central banks, means that things are a little more complicated. There are these private dealers who are willing to make markets for expected profit, okay? But there are also central banks who are sometimes standing in the wings, supporting the private dealers, and sometimes when the private dealers aren't doing it, the central banks are doing it. So this is important to understand a central bank like Polish Central Bank, that it is actually operating as a foreign exchange dealer, okay, in moments of difficulty. It's absorbing fluctuations in the demand and supply for local currency and that come from balance of payments problems, but also just capital flows. You know, it's not necessarily about selling more goods it's also about capital flows increasingly. This is the world we're living in, the fluff, as Copeland called it, the stuff below the line. Okay, not goods and services, but all that other. The fluff is where all the action is. So you need to build a conceptual understanding of the system that is rested on the fluff and is not saying that is tightly connected to the real economy above the line. It's got its own logic of operations. Last two slides. So there's going to be a spectrum of hybridity. At the core of the system, the reserve currency, basically you're talking about deep and liquid dealer markets. It's all dealer markets. The central bank is just stepping back and not paying too much attention to what's happening. It's just backstopping. The market is, and at the bottom of the hierarchy, no private dealers are willing to do anything here. And so it's just the government. It's just the central bank is doing all the dealing. If you're in a poor country somewhere, that's the nature of it. There's not really much in the way of private dealer action in markets, or the private dealer action is just distribution of the central bank action. It's not independent. Maybe there's a little black market or something like that, but the central bank is key. And then there's intermediate cases in the middle, and some of that influences. There are different exchange rate regimes we need to see through that lens as well: floating, fixed, or intermediate. That I mention this in particular because often when we're teaching students the theory of foreign exchange, right, we say, imagine two countries, country A and country B, and there's demand for currency and supply of currency, and there's demand and supply, and they cross, and there's what I'm trying to, and maybe that's okay as a first step. But that is buying into the Westphalian fallacy, okay? That these countries are at the same level in the hierarchy, okay? Whereas almost all the action is not between countries at the same level, but between countries at different levels, okay? That therefore are not equal. It's asymmetric, okay? There's the country that you're doing business with, the ECB, prints money, global money. You don't, okay? It's not the same. It's not the same. And we need to deal with the real world. We need to deal with the actual nature of this. For countries that are not at the center of the system, thinking about speculative attacks on your currency, thinking about carry trades, uncovered interest parity, thinking about risk bearing, thinking about what I call uncovered default premium, unbiased default premium also. These are issues at the center of attention because your liabilities are not money, they're speculative asset that are being traded by other entities. This is the last slide, just as inspiration for next time. This is a paragraph from a famous paper by Kindleberger and two other authors in 1966, when the Bretton Woods system was coming under stress. And there were some people who were imagining that the dollar was going to collapse or something because the U.S. didn't have enough gold to support all of their outstanding liabilities, short-term liabilities. It was a bank in trouble. And so there was some pressure to create a new international currency that was not the liability of any nation. That was the SDR, the special drawing right of the IMF. And here's Kindleberger writing in 1966. He's saying, and I'll read it slowly because this is a lot of wisdom here, according to me. He says, an effective, smoothly functioning international capital market is itself an instrument of world economic growth, not a nuisance which can be disposed of and the functioning of which can be transferred to new or extended intergovernmental institutions. He's saying markets versus IMF, markets, okay. The main requirement of international monetary reform is to preserve and improve the efficiency of the private capital market while building protection against its performing in a destabilizing fashion. Okay. So he's saying outside spread, not inside spread. You know, that the government, there's something that's going on that these profit-seeking dealers are doing in international capital markets that is good for the economy. And if you shut that down, you're going to be causing some trouble. You can understand the political impulse to shut it down. It causes instability. He's saying, let's put bounds on it. You know, create institutions that put bounds on it so that it doesn't create political turmoil that bring people to shut it down. This is the challenge we faced in 1966. Okay, and a little bit later, and Bretton Woods went away, and what did we get? We got the Eurodollar system. We're going to see this. The actual apparatus of the international monetary system, which grew up after the collapse of Bretton Woods, and it worked for a while. Okay, now we're confronting basically the same kind of situation. There's a lot of push to move back to autarky, to say, well, it's just too unstable. We need to just have, and Kindleberger's words are things we should think of right now. The real problem we confront is how do we make this system work so that it can work for all of us and we can continue to have economic growth and good lives. When the international monetary system breaks apart, we get global depression. That's what we've learned from history. So the stakes are pretty high. We'll talk about that next time. Thank you. We have a few minutes if there are comments or questions. It's not yet 11:30. I see we have 7 minutes by my watch. Maybe, is there another microphone somewhere? I'm aware that there's a lot in this lecture here. And so, is there another microphone here somewhere? Oh, there it is, yeah.
There aren't any questions from the part of the students, maybe I just as a brief one. Because you mentioned this Dodd-Frank Act in the US and this post-crisis regulations of shadow banking. We had actually something similar in the EU. There were also 2 directives on shadow banking regulation. They imposed many strict requirements on shadow banks, actually money market funds, this wholesale banking market. There was actually a very intense discussion whether these regulations won't put too many constraints on shadow banks, because as you showed, this provides a lot of liquidity to the whole banking market. So my question is, I would be very interested to hear your opinion. What would be the best response, the best regulatory policy response, how to regulate shadow banks? Thank you very much.
So the question was about regulating shadow banks, and more specifically, I think about what do I think about the way that Europe has regulated shadow banks. I suppose I will not answer the second half, just because I don't have a developed view on that. And I have learned from the crisis that my value add is not so much at that level. I was involved actually in creating the in the policy, chaos around creating the TARP bill, and I lost 2 months of my life in that, and so I'm not going to do that again. I'm going to write books. The key idea, that comes from the money view about this is creating the outside spread, being dealer of last resort, that the central bank has to be the dealer of last resort, that is what is going to create stability in the system as a whole. My impression, I don't know if it's true in Europe, but certainly it's true in the United States, is much of the discussion of regulation is more focused on, should we outlaw shadow banking, or should we even have it at all, or something. And I think this is mostly not helpful conversation. I think you're going to have it. So you can pass laws. All that means is that it's going to happen offshore where you can't control it and regulate it, and that's not a good idea. You're better to have it under your nose where you can watch it. And backstop it, and so there's this outside spread that you need to be creating. That means in general, most of the time, central banks, regulatory agencies, will not be trading, will not be buying anything, will not be selling anything. It's a backstop, And so in normal times, you're not involved in this market at all. There are still moral hazard problems that come from this, and they need to be addressed. There are moral hazard problems in the lender of last resort function. And they were addressed by Bagehot with this idea that you should lend freely at a high interest rate, and against good security. That's an attempt to deal with the moral hazard problems. And I think there are analogous things you can do for the shadow banking system. So that's the first point. Second point, that I think is maybe, I think probably you can do that, The more politically challenging thing is the second point from the model of shadow banking that I have there, is to appreciate that this backstopping function is not just about money markets, It's also about capital markets. It's not just about the global money dealers, it's also about the global derivative dealers. The notion of backstopping traders in risk, I think, is a big step politically, and a difficult step politically. Logically, you can see in this framework, it's just the next step. It follows. It's the same. If you have shadow banking system, money market funding of capital market lending, there's going to be the source of instability can come from the funding side, it can come from the risk side, and so you need outside spread there too. And that is not only politically challenging, that's more new in history. We're used to the idea that central banks are backstopping money markets. Bagehot wrote in 1873. So we've had, more than 100 years to say, okay, lender of last resort, I guess that's okay. When Bagehot wrote in 1873, and he said, central banks always do lender of last resort, let's just admit that and bring it up to consciousness and say, we're going to do it again, and let's try to refine that. That's what he was saying. This book was savagely reviewed. Like, oh my God, look what he's saying. He's saying to backstop the banks. This is horrible. But this became orthodoxy. We are living today in a Bagehot moment, just like that, where I'm saying you're going to have to create an outside spread for risk dealers. It's dealer of last resort, not just lender of last resort. That's the nature of a global system. We're at early days. That's why I say it's a Bagehot moment. Just 1873 when he wrote, this is the beginning of modern monetary policy. There is nothing in Lombard Street about monetary policy. It's entirely about how to put a floor on a crisis. I think that's where we are in our knowledge about the modern system. We know how to put a floor on a crisis. At least I'm trying to say we know. That's this lecture I just gave. I said, I think there are lessons that we learn from this, and I am confident that the people who run the world have learned those lessons. They may not use these same words or this same intellectual framework, but I think they will do more or less this. But what now? That's not the end of the story. We want that means there's going to be implications for changes financial structure in the private sector. There's going to be implications for management of the system in normal times, when this outside spread is not being hit because prices are in between. How does monetary policy work? How should it work? What is the role of central banking? All of these are new questions. We're in a brave new world, and so a lot of these issues have to be rethought from the ground up, from the fundamentals. That's why, and meanwhile, people whose job it is to write regulations, so I'm coming to your second part, they have to write regulations, okay? And, I'm glad it's not my job. Like, I'm not sure that we really know enough to say, well, what would an optimal set of regulations be? We're going to be learning. I think we're in a learning by doing kind of moment. And we have written some regulations. There's Dodd-Frank, and there's some international, and there's Basel III. There's various little things that are out there. And then we're going to test them in crisis. And we will discover that we did some stupid things, and we'll change them. And we discovered that we missed a bunch of stuff, and we'll change them. This is not, I just want to tell you, this is not the fact that this doesn't come from the fact that the people who wrote the regulations were stupid or venal or corrupt or anything. It's because we're living in a new world. And hopefully some of you will make your lives in building this new system. Because I think it's that time frame. That's what we're talking about. This is the next 30 years. Okay? That's a project to make this system work. That we have been building little bit by little bit in such a way that we didn't even recognize it as a system. We just thought, my job is, I'm securitizing these mortgages. That's what we are. And it's like, okay, but what's that about? Now I think we're seeing the outlines of the system as a whole, and so we're seeing the need for regulation and the need for a logic of regulation that is consistent across the system as a whole, not little thing by little thing. If you read Dodd-Frank, it looks like a list of 1,000 things that need to be done and 1,000 policies for each of these things. This is not a coherent strategy for regulation. That's why I have simple models, okay, where I say, here's a way of thinking of the system as a whole. Have that in mind when you're writing a regulation. And ask yourself, is this thing, creating an outside spread? What am I doing? What is this regulation doing? And having a model to compare it to. So that's my contribution. Maybe that's not, it doesn't give you enough advice to do your job every day, but I think it will. My experience with my students in New York is that it is very helpful to have a mental framework, to understand where your little piece of the system actually fits. It's helpful. And if people who are in little places all have the same mental framework, then we're going to get a consistent regulatory structure. If they don't, then we're going to get an inconsistent one, and there's going to be a lot of work in gaming that and arbitrage, and all of that is just social deadweight loss, and there's no point in that. Okay, and we will eventually get a consistent regulatory structure being driven by that arbitrage. But better that we try to think about it a little bit beforehand. So just some random thoughts about the problem of regulation. Yeah. Do we have time for? No, it's 11:30. All right. As usual, the professor uses up all the time in his answer and doesn't get more questions. But we will have more time this afternoon, and I look forward to continuing the conversation. We're having 2 talks about shadow banking, so we're really going to be digging in. Okay? See you then.